in my mid-20s and in my mid-30s, I ran into severe suffering financially. I hate it so much that I just had to keep going. When you want some defense in your portfolio, that's where gold comes in. And I ended up having to puke stuff out to pay the bills at the lows, when I knew in my gut that those, companies were laying on the ground just there for the taking if you had cash. When you want offense on the portfolio, typically that's where Bitcoin comes in. There's only one sector I know of. It's the mining stocks that are still very cheap.
Welcome everyone to Navigating the Minefield, where I talk to Eric Maszynski about everything to do with mining, crypto, precious metals and macro. Hi Eric, how's it going?
Good, Roger. How are you?
Very well indeed. Now, I want to talk about in this episode, really just some of the learnings that we've had, because they're so relevant to what's going on at the moment with gold breaking out, with Bitcoin, crypto breaking out. But some of the things that we heard from Rick Rule and Rob McEwen, I think are so relevant to this environment, because what I found fascinating about their discussions were that it seems in this space that you've got to take a lot of pain to get the gain. I think particularly Rick was talking about how he basically almost went bankrupt at one point. He survived. Rob McEwen was talking about this sort of pain that you have to go through in this space before you have successes. And, we've talked about this before, how there's all the haters because people want success right here, right now. But something you've always talked about is that you've got to expect and deal with quite a lot of pain in this space before you have the success. Is that something that you've experienced? Have you also had those moments where you just thought, oh my God, I wish this would end. Is it ever going to come good again before things have turned around?
Yeah, I think that's why at this point, when things get kind of nasty during a bear cycle, I don't feel that way. I lick my chops because I know that this is a cyclical arena, as is crypto. So look, from my experience, I don't know a lot of really successful traders and investors that haven't gone through massive periods of drawdown if you are looking for enormous type of returns. So I did a write-up in 16 or 17 on the Gold Investment Letter blog about drawdowns with Amazon. And it didn't even matter that it was tech. If you bought Amazon in 2002 or 3, when things started kicking in for the business, but the internet bubble had popped already, that you were good. It had a 70% drawdown during that next few years. And going into 2008 too, none of those got, they weren't immune from big hits. So new technology companies, gold is the king though, for sure, still, in terms of defense. I'm talking about physical gold, but owning mining companies is certainly an extension of that. They can get affected by the capital markets sentiment, the macro, the sector, and then the individual companies. But, back in 08, I remember it was less than a 30% drawdown for gold prices from high to low. And that was brief. So, if you're down 20% on your money when the rest of the world is down, 50 to 90, that still plays a very good store of value presentation. But yes, in the mining companies, which until crypto came around, I was telling somebody about the fact that I got into the junior miners, the penny dreadfuls, Rick talks about, because this was the area where you could have the, 50, 100x type of returns potentially because of a discovery or because you just bought at the right time in a bear cycle. And then, those things go to frenzy levels too. And that could be in subsets of the mining sector, like uranium or, like lithium or, like copper. And we're going to see that happen again. And I think the reason why we kind of started this show, this series back late last year was because, I was itching to try to get on the record with people, as many as I could, because I just felt like this bear doesn't have that much more to go. Initially, it could be a gut punch and I've almost gone bankrupt twice. I just didn't have the levered obligations that Rick did. Otherwise, I would have had to look at it. I was actually living simply, so I was able to avoid it in 08, 09. And then I actually blew up. My first run in the business was the internet boom. And then the bust side wiped me out completely. So twice in my adult life, in my mid-20s and in my mid-30s, I ran into severe suffering financially. I hate it so much that I just had to keep going. And then things change, and they can get really, really good. But dealing with these things and the volatility of, assets that you want big reward on have correlated risk. So the timing of when you're getting, involved is very important. That's why I encourage, seed planting and steady accumulation during really bad markets. And I've been encouraging that, with my group, my elite members and I. We've been socking away small positions and small juniors with warrants that are good for 4 years. So, we get double the boost. I was on uranium, ironically, I was 2 years to 2.5 years early on when I thought the bottom of the market showed up at the end of 16 after a long bear cycle. Looked like I was correct and a genius right away on a technical bounce, and then rolled back over, went to new lows over the next 2 years. But then, as we've seen in the last 2 to 3 years, fortunes have been made in the right uranium plays. And so I've gone through exactly the same thing. I just don't know that somebody who's newer is not going to be able. Most of the people that watch Real Vision have been around the block a little bit. And, I think everybody knows what we're talking about. But one example was that I really was finally prepared in my career with cash in emergency accounts, was the crash of the COVID crash in 2020, where I felt for the first time the pit in my stomach watching particularly my stock portfolios. I wasn't really too worried about the crypto. I still had a fairly modest amount that was there, and I was trying to accumulate. I was like, okay, this is a good thing. I can put a little money to work in crypto again before this stuff takes off, which I did at extraordinarily low prices on some stuff. But then even in gold and silver, I don't know if you remember this, if you followed the space closely enough, it was either March or April of 2020, the 3X ETFs, where you get on gold or gold miners on the long or the short side. I still remember, I don't know the exact dates, but it was a Friday. We had gone down so far that actually my stomach, I was feeling it because my account, one of them was primarily mining stocks. I don't know what it was down in a couple of weeks, but it was over 50%. It was a lot. It was like huge. And then I started to feel it in my stomach. And I'm like, wait a second. If I'm feeling it and I'm an emotional mutant at this point, immune to this stuff, it must be getting pretty close. And then I was looking at all the emails and texts I was getting from the hoodoos that usually ring the bell at the bottom. And then Monday morning, we opened limit down the 3X ETFs. They blew up. They both, long and short, went to zero. And I said, this is the bell. I put out an email. You can still find it to this day to all of my subscribers, free and paid. And I said, I'm buying SLV silver leaps right here. And I'm putting a good amount of money in them. And those silver leaps went up between 7 and, depending on where you bought them, 7 and 12X in like 5 months.
I'm not recommending that the trading methodology should be one where you go potentially bankrupt twice. I think it seems to be very sort of.
Well, that was when that was before all this wisdom came around.
before it became white, the whole thing. I mean, but it seems one of those things which does seem to I don't know. It's almost like a badge of honor for a lot of US investors, stroke traders that I've met and known, because until you about go bankrupt, you don't know what you're doing in trading. And at this point, this is why I'm going to just say, of course, this is all for education and engagement purposes. Everyone should know their own investment horizons, why they're investing, do their own research, etc. And only do your nuts, or only be prepared to do your nuts if you're willing to take lots of risk, but know the downside risks with that. This episode is going to be almost like a rerun of the how to invest in the minefield, because we've got all these things now starting to move. But one of the things that's been interesting recently, and we're getting a lot of that sort of really big ego stuff back into the crypto space. But as it currently stands, I believe this is on the 12th of March, the ratio of gold versus Bitcoin has still not broken down through the previous low of a couple of years ago. Gold has still outperformed on a 2-year view. Now, a lot of people say, just put your money into crypto and hold forever. Some people say gold is dead, there's no place. I look at that and go, okay, I've got these various time levels where I might need to invest over 5 years. And if I have a 50% drawdown between 1 year from now and 3 years from now, that doesn't help me. You look at these sorts of things and think they are complementary because you use these emotions of extreme pain, extreme happiness, to use those as opportunities to switch and basically protect capital and hopefully go again.
Well, yes. And let me just note that when I'm talking about the first and second bankruptcy possibilities where I was just on the edge, the first one, I was 25 years old. Okay. And I was just learning about the capital markets. I didn't really understand cycles. And then the second one, there were a lot of people that ran into trouble in 08, 09. And I was immune because I was in the venture business and everything was illiquid and nobody wanted to do anything with me. So, but these things that I've adjusted over the years were because of a promise I made to myself. It was in the like 13 to 15 or 16 area. I had one of these big drawdowns that happened. It wasn't the one in 2020 and it wasn't 09. But it was another one of these things where my position sizing was too big for the purpose you're talking about. If I was real with myself, I didn't have a 3 to 5 year or 5 to 10 year time horizon where I wouldn't need that capital no matter what. So I ended up getting caught and I ended up having to puke stuff out to pay the bills at the lows when I knew in my gut that those, companies were laying on the ground just there for the taking if you had cash. And just like this happens with a lot of different sectors with the cyclicality, I promised myself then that would never happen to me again in my career. And the 2020 crash was the first one that I was able to apply it in a fairly big way and make a tremendous amount of life-changing money between then and late 2021. Your point, you're using the highs of Bitcoin back in 21, yeah. And you're saying that it hasn't broken a low versus gold. If you just look at Bitcoin now in the 72,000 range, that's true, but obviously the trick I think with this stuff is that it's better to be early than late. So for example, in 2022, when the market was still getting smashed in crypto, like in the summer, is when I started encouraging people to start averaging in. And then I literally rung a bell. Like I had a bell in my office. Like I was on videos in the first week of January 2023 when Bitcoin was 16,700. And I said, I believe the lows are in. They're in. You have to now start deploying emergency cash back into crypto. And I was doing that fairly aggressively during the fourth quarter. But I literally, at that point, I felt conviction that we were at the lows. So depending on how you play this stuff, like if you're a sheep that only can buy after something goes up 4x, and then you look at it versus gold, yeah, gold can help you. But if you play those things correctly, then Bitcoin has drastically outperformed gold. The point is they're not supposed to compete with each other. They're complementary. And all these guys in crypto, what they don't get, and trust me, I'm now over 60% of my net worth is in crypto because of all the money that I've made in the last year. And so taking profits off of that stuff, do you redeploy that in crypto or do you put it into cash or do you start, I like to, when I'm that heavy, my allocation is that heavy in crypto, I start moving that into things that I see value in, which is there's only one sector I know of. It's the mining stocks that are still very cheap. But gold itself, this is the point. If you had gold on the books was as a significant part of your net worth in 2021, when it hit into the 60s, it hit it in there twice, right? It did that earlier in the spring, and then it came back and it hit that high in November of 21. I distinctly remember because when things were up so high, all I was doing was constantly taking profits in pieces on my crypto stuff. I needed to protect myself from the volatility because I took on the risk and I got the reward more than I even thought. Then it was about putting it into more conservative asset classes. And a big chunk of that went into physical gold, which is real money, which is the benchmark. I think the real price of performance of anything, you price it in gold. And certainly Bitcoin has outperformed like it's supposed to because of a venture capital stage asset at this point. It's so early. But I remember distinctly looking at my gold performance, November of 2022. I was like, this stuff is so cheap. We're getting near the bottom. Let me see what my physical gold has done in the last 12 months. S&P, it was way down. Bitcoin was down 70% at that time. And my physical gold was down 1%. So talk about a store of value when it's meant to be a store of value. When you're in a bloodbath, you hold Bitcoin and I'll hold gold. I'm going to be a little bit better off because it's not going to go down as much. And then I can use that gold to go buy the cheap crypto. That's what I did this last cycle. And I didn't do it with all of my money. I still held like a good amount of my money in crypto and went through the the crypto winter. But the physical gold part versus physical Bitcoin, guys, here's what I've had the epiphany of with all this stuff. If you're going to put all your money into something that's modeled after something else, why would you hate the something else? Like you hate gold, but even though Satoshi modeled it after a scarce asset and made it even scarcer, they should be buddies. And the fact of the matter is, I think the way to play crypto and gold, why gold is absolutely far from being irrelevant. Number one, it's a $15 trillion asset versus a couple trillion in crypto. And if crypto investors were wise, you would quit bashing gold because gold investors are the one entity in the market that understand fiat currency debasement. And that's why they're in gold and you could convert them over into Bitcoin. Instead, you start talking shit about each other when in reality, with how cyclical these 4-year cycles are in crypto, there are times when you want to increase your defensive posture, meaning maybe that's with Bitcoin at 200,000 plus. When you want some defense in your portfolio, that's where gold comes in. When you want offense on the portfolio, typically that's where Bitcoin comes in. But gold just broke all-time highs. It's not going to compete with Bitcoin on the volatility on the upside either. But gold going through 2,100, we've been talking about this, and now it's in the middle of the month, and I'm thinking that we just hit over 2,200. It's going to be pretty tough to not see a real, genuine monthly breakout after 3 monthly highs that we closed at in gold. Gold is going from the old highs of, call it 2,100. It was below that. We are going to a minimum of 2,700 to 3,200 on gold, and it's probably going to happen within 18 months. That's not a bad move. So let's start comping the Bitcoin thing with gold, with gold in a year and a half. Bitcoin's going to be higher. Gold's actually going to be higher. And then we're going to have a period of time. So it all depends on the period of time. We start entering a crypto winter again, and gold sticks in there then. The lows are at 25, 26, 2,700. Coming down from, say, 2,900, 3,000 in its move. I'm telling you something, you're going to be very pleased to have an allocation in an asset class that only draws down 10, 12% versus your Bitcoin and going through a new winter. It's probably not going to draw down as far going forward. This may be the last, I think, 10x upcycle from lows that we see in Bitcoin because of the institutional adoption. That's my guess. But you're still looking at an asset during crypto winter that's going to get cut in half or more. And so that's the way that I put it in perspective.
Probably gold's still going to have very good diversification qualities, which is one of the things people like it for, because what we're seeing effectively now is that a lot of this move has been on the back of central banks rather than institutions. And yet what we're seeing with the Bitcoin ETF is that institutional money is going into the ETF, which means it becomes more correlated with the rest of the market if institutions get in there, simply because when you have drawdowns in other assets, and if they've got profits in, let's say, crypto, Bitcoin, they'll take those profits. One thing you're mentioning there, though, I'd just like to almost go back a little bit, which is something that Rob McGeown mentioned It's something that Rick Rule mentioned. Something that you talked about is that you've got, the time to buy these is when there's the haters out there. In fact, almost it's intolerable to want to buy these things is the time to get into them. And as you mentioned on the other side, is when people are doing the high fives, slapping each other on the back and saying it's going to the moon is the time that you want to get out. The reason why I mention this is because when we look at the miners, you'd say that because everyone hates it, this is still the time to get in.
Well, the producers have moved pretty nicely off their lows just in the last week, but commodities and precious metals and mining stocks have typically been a very cyclical area. Okay. So has crypto, but in the miners, very cyclical forever. As far as I can remember back to whenever, they have booms and busts as well. Earnings matter, right? Earnings, you have multiples on cash flow and price to earnings ratios and net income that is always going to be valuable for a business, right? So when the gold price is going higher, after the producers have had to tighten their belts, plus with costs going up, they've had to tighten their belts with gold not, going high enough. But, if the gold price is now at 2,200, 2,150, 2,300, if that's say like a new base from 1900 a year ago or so, a lot of that drops to the bottom line for these companies. And so then what happens? You need a little bit of traction. McEwen Mining, they came out with earnings a week ago, Friday, and they went from like $1.18 or 22 cents in a loss in the red for earnings a year earlier, and they flipped to over $1 a share in earnings on the other side of it, and the stock went up big on big volume. So earnings count, and that's where I would say that then you have a trickle down. It's just a matter of time. So the stronger that the producers get and the better that they feel about, where their balance sheet is, the more they go fishing and hunting for either partnerships to build new mines, or they just start gobbling up, the smaller companies. And that's where those were going to start to get a premium versus a discount to their NAV. And you have always this excitement around what if they hit on their drilling and they find a new ore body that's going to be massive. So that you had that element of excitement to it as well. I love the space. I'm still very involved in it. The key is you got to be early, and that's what we are right now in the miners. So that's why it's so important to pay attention to the space. Go write it off after this stuff goes up 5, 10, 100x in the juniors, and then write it off. But for now, if you want exposure in something value orientated, where are you going to find it in these markets? Hard to find.
If this is an area which is still being starved of the retail interest, the individual investor interest, who may be more focused on crypto now. But I think you mentioned before, and you actually mentioned it there, the bigger names are going to start looking at M&A and looking at picking up some of these stocks. In the same way that we've seen, big, not institutions, but big corporates coming into the copper space and buying into copper deposits.
Yep.
Because if there isn't the investors there, these are cheap for the actual companies that need copper in the future. And we know the big structural bull story there. In the gold space, are there any signs that some of this M&A is starting to kick in? Are people starting to talk about it? Are any of these names starting to be lifted?
In the case of what you're talking about, which was pretty interesting, is like Canada Nickel. I follow nickel pretty closely. I'm very bullish on nickel, actually. Giga, symbol GIGA in Canada, and GIGGF in the US, this thing has been bludgeoned to death. But if you look at just recently, it's had a little bit of a bounce. But Mitsubishi came in and bought, this is over 18 months ago now, I think. They bought a 15% stake in the Turnagain asset. So they didn't buy it into Giga, so it wasn't dilutive to the share structure. They bought the interest in the asset itself. They formed a new co together, gave them $8 million Canadian for the 15%. So that valued that investment just in the asset, and Giga has some other assets on the books, but that's the main one, at $53 million. And where was the stock at that time? It was like 20 million. It jumped up to like over 40 million on the news, and then it rolled all the way back over. And just like last week or the week before, it was at $10 million. So you have Mitsubishi that bought in there. And I know that that company, for example, they want another partner, if not an outright buyout next. And so they're talking to some of the largest companies in the world. It's no secret. You got the car companies and you have the mining companies. And then you had, what is it, Samsung came in for a piece. So you've got like really interesting dynamics. And McEwen had Stellantis, fourth largest car company in the world, invest in McEwen Copper. You had Rio Tinto, the largest mining company in the world. They invested in McEwen Copper. But are these buyouts, are they happening where they're coming in and then you're seeing these big lifts in the stock? No, some of them are seeing more on the stakes and the partnerships than outright buyouts. Because frankly, Roger, the opportunity here too is that we've had such a slow, underinvested sector for 2 decades that a lot of these assets still need to be developed more and taken to pre-feasibility, even PEA, pre-feasibility, feasibility study before you're going to look at building a mine. So instead of outright buying them, a lot of these big companies are taking stakes in the assets and then saying, get on it. Let's accelerate this thing, and we're willing to pay a premium. So like in a decent market, companies that have, price valuations to NAV, you would think they would trade at least at 1-to-1, and then they get a premium if they're going to get bought out from the net asset value, right? Because there's still plenty there. You have all the time, energy, and capital that has gone into this. That would be more of a normalized market. So it's really way out of whack. So on like the gold company side, I've seen more of that too, where you're seeing the bigger companies are starting to allocate more capital to little stuff. But we're very far from like an M&A frenzy.
The conversation you just had then was that these big companies are taking stakes rather than buying them out because they need them to be developed because they see the value down the road. It sounds like the right way to do this, and is what you said at the very beginning of this episode, which is you've been looking at warrants on a lot of these companies, 4-year warrants, so taking these slightly longer dated views. Because in some ways what you've outlined there is something where people still need a bit of patience. Yes, the gold price might get to 2,700 and lift everything higher. But in the meantime, if let's say the gold price just sort of grinds slowly up, it might be that people need to look at this on that sort of 1, 2, 3 year view. So could you explain the options or the warrant market and how you look at that and what you do there?
These are in private financings, private placements. So you have to be an accredited investor, which typically means if I'm an American and I'm investing in the placement, I have to have either 200 grand a year income for at least 2 years in a row, $1 million net worth, not counting my house, that also qualifies, or a $300,000 income with your spouse. Those will give you the access to even be able to do these. But then go, good luck going to try and get 3 to 5 year warrants. I get those for my group. I scour this space and I find deals that are at really very low valuations. Typically with these financings, warrants are used as a bonus for putting money directly into the company. For me, in these conditions, I have been negotiating for our group. I tell them, the companies, I'm like, I'm already a shareholder in a lot of these companies before we even have the talk. So I'm not trying to kill them or kill myself, but I say, you can afford to do a cheap financing with a long warrant if you're getting a new group of potential long-term buyers that are coming in, that's going to expand your base. So the warrants don't trade in most cases. They're just an option it's a long-term option to buy more stock at a specified price for a specified amount of time. But 4 years is a long time. They boost your overall returns considerably if they go up from the warrant prices. And this is what we are like really active in right now. And a lot of these are smaller placements, but the small companies have no negotiating power. They're broke. Some of them are running on like total fumes. They're out of money, but they need money to drill and they need money for talking about their company out there in the public. And so we give them some money to go do some work, pay their bills for a period of time and live another day. and we get it under very, very attractive terms. So that's what I've been busy doing for the last year. I love these environments. The warrants are just a kicker.
It's obviously going to be quite hard for a lot of individual investors, therefore, who may not have that sort of capital to spend on, which then goes back to, okay, you've got to invest in the stocks. But as you mentioned there, and something Rick Rule mentioned, the penny dreadfuls, most of these stocks probably will die. Maybe 10%, 20% are good. How do people pick those? Because that's the minefield that right there is that if I went and picked 2 stocks and I picked 2 stocks and go to 0, I'm not going to be particularly happy. How do I avoid doing that in this space?
First thing I'd look at, and this is the same thing with tokenomics and crypto, share structure. So if they're apt, the management team and the board are like, Vancouver lifestyle CEOs, we call them, where they're taking salaries from 3 or 4 different companies. They have no skin in the game in any of the companies. They've rolled back shares already in 2 or 3 of those companies, doing 10-to-1 rollbacks and starting over. And then you look at their career and they've been around, they're geologists for 30 years and they've done that like 15 times. Stay away from those. Number one. Number two, I like the tight share structures because you can get in for low valuations and then that they're very careful about over diluting. And then you have room to raise a good amount of money as the stock rises to do a lot of work. The other piece I like to look at is, do they have resources already? Then you look at going in and saying, all right, well, there's been 3 decades of work and $100 million spent on drilling out this asset that has, 1.5 million, 2 million, 3 million ounces of gold in a category that has been verified by a third party. And this company actually has a little bit of cash to survive and maybe drill. And their burn rate is really low and they've adjusted. And so those are the ones that I like to do. The beauty is, how do we know which ones are going to survive? Well, if we start buying up a stake in the open market and then we give them $500,000, $1 million bucks. I mean, there's a lot of these juniors right now that I personally own between like 1% and 7% of the shares outstanding. Once we're a little bit pregnant in the deal, it's not going broke because I'll fund it as long as it takes for the market to get better. It's not going broke. When you raise the money, you do just enough to get some drilling done or get a little bit of work done to keep moving the ball forward. But when it's a cheap valuation, you keep a cap on that. And that's one thing that I look at when I advise these guys and the boards and the girls, the women that run the companies. I say, listen, a lot of them will come to me and I'm like, what are you thinking about doing next? And their stock's at an all-time low and a $3 million market cap. And they're like, oh, I'm going to raise $2 million next week. I'm like, you're giving away 40, 50% of your company and you have this big asset. And so I'll get them to come way back and maybe we give them a combination of the company has interest and then we get involved. I'm like, I'll only get involved if you raise a maximum of $700,000 Canadian. And keep your share structure. This is a stair-step round, and you have to slow your roll because I know you want to go drill the heck out of this project because you're excited about it, but now's not the time to give away half the company to do it. It makes no economic sense. So that's where I also try to help the companies because some of these people just are not finance or capital market savvy. They're more like technical geologists. And then the ones that do understand the marketing, that you have to do marketing in a lot of this stuff and understand, investor speak. That's where you get the shady promoters that come in and take these things over and pump them up and dump them out. So yes, it's a minefield. That's why we titled this series that way, because a lot of them can blow up. But here's the thing. You mentioned, 10 or 20% of them may work. It's actually not true. Any of these that survive and have any cash or solvency, and we start going into a bull cycle, they all go up. It's just a matter of which ones are, still here and which ones go up the most.
So let's say there's people out there currently sitting on cash. They've got the opportunity. The liquidity cycle is still very positive. I spoke to a chap at Cross Border Capital called Michael Howell who said 2022 liquidity turned up. It probably goes into 2025. There are 5-year cycles. The upside's got 9 months left. So let's say we've got this 9 month, which could be lifting all boats. So it could be crypto, Bitcoin and various crypto assets. It could be gold further, silver further, miners further. If someone's starting from scratch today with 100% cash, pretend, how should they approach this?
I don't know why somebody would be 100% cash at this point, but I can tell you where I put my fresh cash. This is also obviously up to each person's risk tolerance and where you're at in your life and all that stuff. I'm not your financial advisor. We're not giving financial advice. But what I see out there, you know, aping into crypto right now after it's up 5x in 15 months or less. If you decide you've been doing your homework on Bitcoin and crypto and you're like, I need to own this, okay, but you haven't pulled the trigger, I wouldn't go 50%. There's a difference, right? Than me going, oh, I'm going to put more money into ETH at 4,000 or into Solana at 150. I own Solana, but it's at $17, $18, $19. So I would have a tough time telling anybody to go 50%, number one. Number two, I think with crypto, you've got to get started somewhat slowly and keep that in a position size that will allow for and visualize yourself getting a 50% drawdown. That's why, like, I always tell people to buy in pieces. Like, say you wanted to put 10% of your capital in crypto. That's where you really want it to be eventually. Then put 3 to 5% to work right now. Fine. And know that you're not going to touch it for a while and hope that a big drawdown comes soon. So that you have, say you put 3% to work today, you've got another 7% to put to work, and you're waiting for these dramatic pullbacks to happen, which they will. And they're freaky because they happen so fast, and there'll be 30, 35% drawdowns numerous times, even if Bitcoin's going to $250,000 by the end of next year. So my suggestion is you wait for, allocating in down markets, train yourself that way. In gold, physical gold, I don't know why anybody out there, including all these really rich crypto bros, if you don't have 10% of your investable assets in physical gold, I don't necessarily mean you have to have the bars and coins. If it's not that much money, I tell literally people, like friends, I'm like, if it's only 10 to 50 grand or something in physical gold coins, go in there and put it in your sock drawer. Throw it in there, and nobody's going to look in there, and you throw it in the back of your sock drawer. Then you have to deal with storage in ETFs, other safe, like a safe, other places like that. There's goldmoney.com that stores it for you for a small fee. And we know they have the physical gold, but you don't have to store it yourself, right? And then as far as the mining stocks are going to be where I would allocate, 20% of my fresh cash right now, and get it up to 25 or something in the coming weeks and months, because it's just tons of value that I see there. As far as general market allocations or in QQQ or in tech or in bonds, I have zero. I'm not involved there. I have the vast majority of my net worth is in metals, mining stocks. Physical gold is my safest place for money in the world. I have cash of a decent amount that I've been taking profits from crypto, but a lot of that money from my massive crypto profits has been going over into gold miners, copper miners, silver miners, nickel miners. There's going to be a point where everybody needs the metals and, to operate. We're not going to be on a computer. You're not going to drive your car. We're not going to be able to do anything with tech unless you can build the hardware. And then all of a sudden the supply chain is short on everything and the prices are going to get squeezed. There's going to be a lot of value for, I think, investors that own assets in the ground that can be or are eventually going to be extracted.
Everyone has to know, as we've said, know their own risk limits. I suppose for most people, you have this stuff, 10, 20% of your portfolio. You have the high octane stuff maybe is 10%. So that'd be miners, be cryptos, etc. 10% gold. Obviously, the younger you are, the more of that risk you can take. Maybe the older you are, or the closer to retirement, or the closer to just a basic income you want, a smaller amount. But everyone's got to do their research, because you talked about the research that you've done on those junior miners, the ones where you checked out, the structure, the ownership, the resources in the ground. There's no free lunch in this. I know people want to be told what to buy, then it goes up 10x and they sell it and they'll give you no thanks. And that's not really how this game works.
I'm familiar with that part. You make somebody 10x and they don't even, they're the one who picked it. If it goes down 30%, I'm the one who picked it.
Well, brilliant. Okay, great to have your views again. And we're going to keep this journey going for another couple of months, because this is an incredibly dynamic market where a lot is now starting to happen.
It is, and this was my hope. I was hoping we'd maybe start a little bit more aggressively in January in like some of the mining reactions and things, but we're in March and gold's getting stronger. The metals are getting stronger. We're seeing some bids in the producers, and some of the small ones have actually seen these like shoots of volume. So spring, I think, is here, or it's certainly coming. And if we can get people interested in that space that are open-minded here, then, you know, you've got some opportunity to make a lot of money as we move forward.
Great. Well, hopefully we'll be doing a few more updates next week and beyond there. Thanks a lot again. Thanks very much, Eric. Speak to you later.